All right, let's tackle one of the biggest myths out there about money. You know the one. The idea that investing in some exclusive club, only for the super wealthy. But what if I told you that the ticket to get in is probably sitting in your wallet right now?
I mean, seriously, is that the thought that's been holding you back? The feeling that you need this huge pile of cash just to get your foot in the door? Well, we're going to challenge that idea right here, right now, because the actual number you need to begin, it's way, way smaller than you probably think.
Yup, that's it. 100 rupees. This little note is your entry ticket to the entire world of investing. Today, we're not just going to talk about it in theory. Oh no. We are going to show you the exact steps to turn this single note into a real wealth-building engine.
Okay, so you've got your 100 rupees. Now what? What's the smartest and easiest way to actually put that money to work? Let's walk through the very first and, honestly, the most crucial steps of your investment journey.
Let's get friendly with a little acronym, SIP. It stands for Systematic Investment Plan, and trust me, it's the perfect starting tool. A SEP just automatically invests a fixed amount for you, every single month, into a mutual fund. And what's a mutual fund? Think of it as a big basket holding stocks from lots of different companies, all managed by an expert. It's a super simple way to get started and stay consistent.
So why are SIPs so effective, especially for beginners? First, they build discipline by making your investing automatic. You just set it and forget it. Second, they use this really clever strategy called rupee cost averaging. It sounds fancy, but it's simple. Imagine 1 month, your 100 rupees buys 10 units of a fund. If the price drops next month, that same 100 rupees might buy you 12 units. See? It helps smooth out the market's ups and downs. And third, they set the stage perfectly for the magic of compounding.
And getting started is just a simple 3-step process. First, you complete your KYC, which stands for Know Your Customer. It's just a standard verification. Second, you find a mutual fund that fits your goals and allows a small SIP. And third, you set up that regular investment. That's it. That's your launch sequence.
Okay, so you know the what and the how, but what about the where? Let's get into the digital tools that make all of this possible, right from the palm of your hand.
Yeah, the days of needing to call up some fancy broker are long gone. Today, user-friendly apps like Angel One, Grow, and LXME put all the power right in your hands. They're literally designed for beginners, letting you set up an account, complete your KYC, and launch your very first SIP all in just a few minutes.
Now, you do have a choice here. You can use an SIP to invest in a diversified mutual fund where a professional is managing the risk for you. Or you could try to buy shares of an individual company. The trade-off is pretty simple. SIPs offer that built-in diversification and lower risk, while picking your own stocks requires a ton of research and carries a much higher risk.
And just a quick word of caution on buying stocks directly. While it can seem exciting, individual stocks are often way more volatile. You absolutely must do your homework on the company's finances. Honestly, for most people just starting out, the SIP route is the smarter, safer way to go.
Okay, so we've covered the how, but now we get to the really exciting part, the why. This is where we see how starting small isn't a limitation at all. In fact, it's a superpower. This is all about the magic of compounding. Let's stick with our number, just 100 rupees, invested faithfully every single month. I know, it seems so small, almost insignificant, but just watch what happens when you give it time. Just look at this. Over 10 years, investing just 100 rupees a month means you've put in a total of 12,000 rupees. But assuming a modest 12% annual return, that money grows to over 23,000 rupees. That's nearly double your investment. You've earned almost 11,000 rupees in pure growth, all from that small, consistent habit.
Let that number sink in. 23,000 rupees. That is the real, tangible result of just being consistent and patient. You see, this isn't a get-rich-quick scheme. It's a get-wealthy slowly but surely plan. And it works. So how does this even happen? It's all because of compounding. The simplest way to put it is, your money starts making its own money. The returns you earn in year 1 start earning their own returns in year 2. It's like a tiny snowball rolling down a hill. It starts small, but it gathers incredible momentum over time.
So, we've covered the how and the why. But the most important part of this whole thing isn't the app you use or even the fund you pick. It's the mindset you decide to adopt. If you remember just one thing from this entire explainer, please let it be this. The market will go up and it will go down, but your success will be determined by your ability to stay consistent and be patient. The size of your first investment is way less important than the simple habit of investing itself.
So what's your path forward from here? 3 simple rules. First, start today, right now. Don't wait until you have enough money. Second, make it a regular habit. Automate it with an SIP. And third, as your income grows over time, increase that monthly amount. Your 100 rupees SIP can become a 500 and then a 5,000 rupees SIP.
The old barriers to investing have completely crumbled. The tools are in your hand, and the path forward is clear. So the only real question left is this: what will your first 100 rupee investment be?